From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is Monday, the 25th of September. This is Bloomberg Markets. Here are the top stories we are covering for you at this hour. Yields keep marching on. The 10-year Treasury yield is at the highest since 2007. Boon's at the highest since 2011. How much do we blame central banks for the sell-off? Or should we blame oil? Crude steadies near $90 a barrel as speculators boost bullish positions to the highest since last February. Vicki Hollub, Oxy's president and CEO, joins me this hour for more on the market. And Hollywood writers have a deal. Screenwriters reach a tentative new labor agreement with studios, teeing up an end to their nearly 5-month strike. But there's no deals yet for actors or auto workers. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alix Steele is on assignment. Welcome to Bloomberg Markets. And Guy, it's actually Alix who will be speaking with Vicki Hollub later this hour. Lots to come on the energy market, but it really is the bond market that has our attention on this Monday morning.
What, is it the weather in New York? I can't figure it out. Why is everybody so gloomy this Monday morning? Certainly on your side of the pond, everybody seems very downbeat. Yep, the bond market continues to push yields higher. It's amazing to see the gravitational effect over here. It's having quite a pronounced impact on European government bond markets. What I can't figure out, Kaylee, is it the weather? If it's not the weather, what is it? Is it the shutdown risk? Is it the oil story that Alix is going to be talking about? Is it just the Fed still sounds quite hawkish? There seems to be a multitude of reasons why we may not be done with this yield story just yet.
Yeah, maybe it's not any one of those individually, but all of them combined. And that collective force, Guy, is what's driving yields to the highest we've seen here in the U.S. in 16 years. We're looking at 451 on the 10-year right now.
I'm amazed. Equity markets actually seem to be holding in there for the time being. But there is a holiday today. Volume doesn't look particularly good. Maybe there's another series of contributing factors into the mix as well. Anyway, as you say, Alix is in Oklahoma once again, this time without the hat. She will be joining us throughout the show. She's got some great guests lined up. We're looking forward to those. Oxy and Continental are going to be joining us over the next couple of hours. Oil, one of the potentially big contributing factors as to why we are seeing yields go higher, Kaylee. Let's talk about our question of the day. I think it's right on point today. Why? Why are yields higher? Let's try and figure out the answer to that question because I think there's a multitude of potential reasons here. Edward Harrison, with you. Ira Jersey of Bloomberg Intelligence is probably the first person we want to be talking to about this. Ira, what is your thought on this matter? I'm trying to figure it out. I'm trying to understand, is it a cocktail of factors? Is there something that is kind of on point here? Why are we seeing yields continue to go higher? Because the inflation narrative doesn't seem to be necessarily part of this.
I think a big part of it is the central bank narrative, and not only here in the U.S., but also in Europe. So, Guy, I have to disagree with you. It's not treasuries that are pulling European yields. It's the other way around. So when you look at the two big moves that we've had in the bear steepening of the yield curve, so the long end underperforming the front end of the yield curve, that all started back in on Thursday during European hours. You saw a very significant increase in 10-year yields, 2-year yields kind of hovered around the same level, and that occurred again last night. So it's really the European investment and the European lack of interest in buying U.S. Treasuries and indeed European government bonds that has really contributed to this big move.
Ed, do you agree with that assessment?
I do.
This isn't a U.S. issue?
I woke up this morning and I saw that we had 5, 6, 7 basis points up in the long end of the curve, and it just extended in the U.S. hours. One thing that I think would be interesting to think about is that we've had an up move. There's a channel upward in yields on the 10-year, which has been nominals, but also been mirrored in real yield. So really in the U.S. at the minimum, it's the real yields that are driving the move higher. We've gone from about 1% to over 2%. We're about 2.12 now on real yields.
Ed, is there also this issue, if it is Europe and maybe we are the tail wagging the dog right now, if it is Europe, what is it that markets are pricing in here? Is it an admission that we are basically in stagflation now? It was interesting, Torsten Slok at Apollo had a nice note earlier on suggesting that if that was the case, and he thinks it is, then what that is ultimately going to mean is higher yields for longer, not particularly good for the equity market, and that's the narrative. That's the playbook that Europe is now going to be putting into place. If Europe is driving this, is that the reason why?
Well, what I would say is it's not necessarily the case that Europe is driving it. It's rather that the Europeans had a crack at taking the yields higher after we opened. It's a combination, both A, of the fact that we have the potential for stagflation in Europe, but also B, the fact that there's a delayed reaction to thinking about the Fed. The Fed in 2024 said we're going to cut rates by 100 basis points back in June. Now, you might think that they would dial that back slightly because the economy's been better. They've dialed it back a decent amount, actually only 50 basis points of cuts that are priced in. That was much more hawkish than people have anticipated, and that is negative for longer-term yields, and that's what we're seeing, this delayed reaction to the Fed, adding to the European narrative that you were talking about, Guy.
Well, Ira, as Ed was just talking about how what we're seeing with the 10-year Treasury yield tracks the move we are seeing in real yields. This isn't break-even driven. That's not what this is. It isn't really, it seems, about inflation expectations. So should we understand that oil really doesn't have anything to do with this, that these moves are entirely separate?
Well, I think oil does have something to do with it, but it's been basically real yields have been the only real driver of the total bond market for the last 3 or 4 months. There hasn't been a significant move in inflation break-evens, like you noted, for quite a long time until they came down significantly. I think the oil impact really has to do more with what is the reaction function of the Federal Reserve and other central banks, particularly in Europe, who care about headline inflation and how that might affect longer-term inflation expectations of the consumer sector. So I think that that remaining at the peak for longer is something that oil prices distinctly affect.
Ed, final point from me to you. Kayleigh brings up oil prices. What effect are they having? What effect is QT having in this mix? What effect are strikes having in this mix? What effect are kind of a potential shutdown having in this mix? What are all these other factors doing in terms of their effect on what is happening with yields right now?
Well, I don't think
oh, go ahead, Ira.
Sorry, Ed. You could both have a crack at it, to be honest.
Well, let me say that I want to piggyback on what Ira was saying and point to the concept that one of the things that's driving this is the fact that we're very limited in terms of what the Fed can do and what the European Central Bank can do. Basically, as long as we have that inflation relatively high, as long as the U.S. economy is not falling off a cliff, how many cuts are you really going to get from the Fed? They're very limited in terms of what they can do. So at the margin, all these other things are going to be of less importance.
Great, guys. Thank you very much indeed. Appreciate both of you joining us. Thank you very much. Ed Harrison and Ira Jersey joining us on what is happening with this phenomenal rate story that apparently is mainly having its genesis over here in Europe. Oil, though, a huge contributing factor, one could argue, in terms of the zeitgeist around all of this at the moment. It is appropriate, therefore, that Alix has decided to take this opportunity to head back to Oklahoma. The 2023 American Energy Security Summit is taking place at the Ham Institute for American Energy in Oklahoma City. She doesn't have a hat, but I guess she's got a lot to talk about. Alix, the oil story is, yeah, there we go, no hat. The oil story is huge right now. This is the perfect time to be talking about where it's going to go from here. Where do people think it is going from here in Oklahoma?
I can't believe you had a picture of the hat for me. Okay, well, I think that we are going to hear from the CEOs is that they're going to look at oil between 60 and 80, right? No one's going to want oil at 100 or plus because that's going to be some demand destruction. Interestingly enough, if you want to have policy that's going to unleash American oil, what that does is actually tank the price. And oil producers don't want oil at 40 or 55. That's not going to be good when it's very expensive to produce this oil now because of inflation and labor. So there's a real tension here as to what actually makes sense. If you unleash the oil, you get lower oil prices, which hurts the producers, which then makes less oil, or you keep it kind of high and then help the productivity and help the cash flow. So that tension will definitely be unveiled here.
Okay, so it basically is a decision, Alex, of keeping supply constrained or not, right? And shale's just one factor in that because, of course, all of these guys are thinking about the counterbalancing effect of OPEC Plus.
Yes, but here, more importantly, I think it's the counterbalancing effect of the energy transition. So I'll be speaking to Ambassador Nikki Haley later on today, and she unveiled her economic plan, which talked about getting rid of the $500 billion in subsidies for green energy. You know what? The guys here, they like those subsidies. They're using the subsidies to build out carbon capture, to build out hydrogen and other facilities. So how do you repeal something that the energy guys actually like because they're plowing billions into the energy transition? Another tension here. And the backdrop, guys, honestly, is China. I'm listening to a lot of speakers right now, and they're all harping on China and having energy security from China, something that we don't necessarily think about in the same way when it comes to the energy transition.
All right, really interesting stuff, Alex. Looking forward to your coverage from Oklahoma throughout the day. Alex is going to be back with us later in the show for exclusive interviews with Oxy CEO Vicki Hollub and Continental Resources CEO Doug Lawler. She also, as she mentioned, will have a one-on-one with Republican presidential candidate Nikki Haley. So tune into that at 1 p.m. New York time and on Live Go. Coming up here, though, we'll have more on our question of the day. Is it oil? Is that why yields are higher? Sarah Kunst of Clio Capital is joining us next to discuss. This is Bloomberg.
Yields are rising.
The higher real yield story.
Why are bond yields rising?
So much of it's been driven by the recent stronger economic growth.
As economic growth in the third quarter has picked up.
Inflation indicators, whether you look at owner equivalent rents or oil prices, are starting to tick back to uncomfortable levels.
We're in an environment where the Fed is leaning towards potentially another hike.
Expectations for the next Fed rate cut have been pushed out into the future.
There's an acute awareness and concern on fiscal right now.
You've got a substantial amount of fiscal spending.
That's something that may actually even pressure Treasury yields modestly higher.
We're still not sure that we are at peak yet.
There's so much uncertainty on the path for Treasury yields.
Bond yields being higher, a Fed that's higher for longer is going to continuously put pressure on just the broader markets.
Those were some of our guests on Bloomberg TV talking about yields as they continue marching higher, which brings us to our question of the day. Why are yields higher? Looking at 451 on the 10-year right now. Joining us to discuss with her thoughts is Sarah Kunst, Managing Director at Clio Capital. So, Sarah, what should we chalk this up to? What's driving this?
You know, I think that certainly oil is a part of the conversation, but I also think that there's a new normal that we have to get used to with oil, which is, you know, once summer's over, that first cold snap starts to hit, you know, there's probably going to be a big global oil producer who suddenly decides that they don't have the supply they thought they had, the price needs to go up, and I think we need to stop being surprised by that. You know, certainly as long as we're looking at a world where Russia's at war with Ukraine, I think that we're going to see them have a lot of supply issues in the winter that really, you know, drives up the price whether we like it or not, and that does have an impact on yield.
And do yields stay higher? And if yields do stay higher, what does that mean for equity portfolios, Sarah?
I think that equity portfolios for the next little while don't have much to be positive about, period. Certainly, you know, higher Treasury yields mean that it's a lot easier to make money there, and you're less likely to be pouring it into, you know, IPOs and other kind of more speculative feeling bets. But, you know, I think that yes, it doesn't have a great impact on equities, but I don't know that that's the only thing driving down equities and you know, making treasuries look a lot more appealing.
Well, when we say it will have an impact on equities, arguably that impact is going to be felt disproportionately in some areas of the market relative to others, right? Sarah, where do you see the greatest vulnerability to a higher for longer rate story?
I think that it's the big tech names. You know, I think that the growth names that have just sort of fueled this massive run, especially in NASDAQ over the last year, and you know, looking back beyond that, the last 3-4 years, I think that those stocks are feeling more speculative and harder to back. I think we're seeing that in kind of the lackluster IPOs that have come out of Instacart, you know, ARM. These aren't sort of the blockbuster hits that people had hoped, because I don't think that risk appetite's there right now.
So what do you think outperforms going into year end? Is it cash? Is it bonds? Is it equities?
I don't know if we're going to see much outperformance. I do think that we're going to see people sitting on the sidelines with some cash, waiting to see, this looming government shutdown again is not necessarily the best thing for investor sentiment. And, I think that there's going to be a lot of people who keep some of that cash on the sidelines to see what happens, after this last rate hike that's, at this point, almost hopefully coming up soon so that people can start counting down to the cuts.
Sarah, you talk about a government shutdown, which here in Washington is basically all we're talking about, and of course is one of the risks on the horizon. But you have many other potential headwinds as well. Mike Wilson over at Morgan Stanley actually publishing in research in the last 24 hours talking about slowing consumer spending, student loan payments resuming, rising delinquencies in certain household cohorts, higher gas prices as well, weakening data in the housing sector. Sarah, is it becoming just a really difficult picture for the consumer now?
It's been a really difficult picture for the consumer. We've seen retailers saying that pretty consistently over last quarter's earnings calls, right? And they're not even necessarily talking about their sales. They're sounding the alarm about something that's a much bigger macro driver. And that was still when, people didn't have to pay back their student loans yet. People didn't have to worry about, their heating bills going into the winter. And so, I think that the consumer's not in a great place. I think the consumer hasn't been in the great place. The difference now is that's really getting kind of priced in. And I don't think it's necessarily going to be a great winter.
Kaylee, it's really interesting. You talk about the consumer. The consumer is many people, clearly. And it's been interesting to watch how the higher end consumer has held up. But you've now got warnings from just about the luxury good companies here in Europe about a slowing consumer in the United States and over in Europe and in Asia as well, and that all speaks pretty badly. LVMH is absolutely cratered, and you do wonder if stocks don't perform from here, what happens to that higher end consumers? They seem reasonably resilient to higher rates, but a stock market setback, I just wonder.
Yeah, if you have all of a sudden all of that wealth that maybe was accumulated and you start to feel like your real wealth is actually much lower if you are invested. Also keeping in mind, Guy, that a lot of this has to do with the housing market as well, which to this point, given rates are so high and no one wants to let go of their existing low mortgage, you still have a lot of value in high home prices. Do we start to see that turning eventually? I personally, crossing my fingers, trying to buy a house, but that'll obviously have an impact as well if and when it does happen.
Absolutely. So Sarah, what do you think? How resilient is the upper end consumer to what is happening here?
My most fascinating data point I've seen in the last few months over that is the fact that Walmart's actually gaining a new consumer, and that's that consumer that does have more money, more wealth, but they're starting to trade down, right? And so we're seeing this sort of down trade. If you have money, you're not suddenly running out of it, but you're starting to think about it a little bit more. I'm watching holiday travel a lot. I want to see, are people booking these big end of year trips, or are they going to stay home and drive to grandma's, because that all has an impact on spend. But I think in general, no one feels right now that this is necessarily the right time, to go buy a $100,000 Birkin or a new Lamborghini.
Which is a shame, because those were the two things that I was definitely thinking about. Sarah, great to catch up. Lovely. Thank you very much indeed. Sarah Kunst, Managing Director, joining us from Clio Capital. I'll just have to put those two things off. Christmas list is changing rapidly. Okay, still ahead, Amazon talking of shopping, entering the AI race. It's made a $4 billion investment in generative AI startup company Anthropic. I should get that one right, learn to speak. We're going to have details on it next. Ed Ludlow will nail it. The startup is coming up. This is Bloomberg.
It's 7:20 on the West Coast, where the sunrise is looking gorgeous. Let's get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its beautiful morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. And Ed, what we have to talk about, other than how good that sunrise you're enjoying looks, is Amazon. $4 billion in Anthropic. This is a big generative AI play. Walk us through it.
Yeah, it's up to $4 billion into Anthropic. In the first instance, it's something like $1.25 billion. But, it's a sizable investment from Amazon in what is a leading startup in the AI field. It has its own foundation models. Claude was a generative AI tool released in March of this year, San Francisco based. But more interesting perhaps is kind of the technical or technological relationship between the two. So Anthropic is going to migrate its platform or software to AWS cloud, but it's also going to train its future models on Amazon's proprietary silicon or AI accelerators, Trainium and Inferentia, which is a pretty big vote of confidence in Amazon's competence around chips specifically designed for AI workloads.
Ed, what do regulators think about this kind of thing? Are they comfortable with this kind of M&A? Because this would strike me as potentially the kind of M&A that means that small companies don't become big companies. They get consumed by big companies before they become big companies.
It's interesting, we were discussing the size and scale of this as a team this morning and over the weekend. Amazon technically takes a minority stake in Anthropic, and remember that Google, or Alphabet, the parent of Google, had already invested in Anthropic earlier this year. So there's kind of an interesting competition, frenemy kind of situation going on there. It's not an outright stake. You know, this is pretty much the most sizable AWS-specific investment that Amazon's ever made. And if you think about what Amazon as a whole has done in the past, this is at a scale that's kind of similar to Whole Foods, right? I think it's probably the second biggest behind Whole Foods. So it's interesting, you know, had Amazon thought about this earlier in the year, before Anthropic had raised money, one would raise the question quite reasonably, why didn't Amazon just buy it outright earlier in the year? But they're not doing that here. It is a minority stake.
All right, Bloomberg's Ed Ludlow, thank you very much. And of course, you can catch Ed and Caroline Hyde on Bloomberg Technology just around 90 minutes from now. Right now, though, we do have to get to some breaking news out of China. Evergrande, the big property developer, a unit missing payments on a 4 billion yuan onshore bond. Guy, of course, we've been paying a lot of attention to this distressed developer in particular. Concerns around it are the reason why we saw property stocks in China down the most in 9 months overnight. There's concern about a potential liquidation, and that's just fresh signs of stress that are in the Chinese property sector, Guy.
And you're already starting to see it kind of rippling in quite quickly into European mining stocks as well. There does seem to be this idea that these guys are so stressed, they're not restocking, they're not planning the next big building project, and as a result of which they're kind of reducing the amount of steel, et cetera, that they're ultimately going to need.
Yep, this is going to be a story that we will continue to keep an eye on. Again, an Evergrande unit missing payments on a 4 billion yuan onshore bond. Coming up there, we're going to go back to Alix Steele in Oklahoma. She's got an interview with Vicky Hall of the Oxy president and CEO. This is Bloomberg. We are an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, it's all about the moves in the bond market today.
The bond market moves are huge, and we'll be taking a look at those in a moment, Kaylee. But first, let's take a look at the S&P 500, because we're looking at something here that we've not seen yet in 2023, and that is 5 down days for the S&P 500 in a row. The last time I looked at the index, it was fluctuating. Right now, it's down slightly over this time period, about down 3.2%, having everything to do with those bond moves that you're talking about after last week's higher for longer Fed meeting. Let's take a look at what's happening today for bonds, and it's not pretty for stock investors, given the fact that it tightens financial conditions. You have the 2-year yield not moving all that much, but take a look at the 10-year yield back above 450. The 30-year yield at 464, up 12 basis points. So this really pressuring a lot of risk assets, also giving a lift to the dollar. The Bloomberg Dollar Index continues to break out of this year's range. Right now, up about 0.4%. Not surprisingly, we have crude oil down, we have silver down, other commodities down. We also have Bitcoin down about 1.5%, really pointing to this risk-off tone. Completing the risk-off tone is the Russell 2000. It continues to truly break down. Matt Miller earlier today really brought to my attention that it's in a correction, and that is true. We've been looking at this chart relative to the Russell 2000, breaking below its 200-day moving average before any of the other indexes, down 11% from the July peak. That's a pretty defined break below the range, suggesting we could see more weakness ahead, Guy. It also begs the question, are we going to see the S&P 500 and the NASDAQ 100 follow suit?
Absolutely. I think a lot of people are watching technical indicators very carefully right now. Abigail, thank you very much indeed. Let's find out where Alix is. We need to go to the 2023 American Energy Security Summit. It is taking place in Oklahoma City, and Alix is joined now by the Oxy CEO. Alix, take it away.
Thank you so much, Guy. Without the hat, it is true, but I'm here with the president and CEO of Oxy, Vicki Hollub. Vicki, it's like my once-a-year catch-up with you, so I thank you for joining me. $90 oil, does it get to 100? Is it sustainable?
I think that we all in the industry have an opinion on oil prices, but usually we're wrong. So rather than answer that directly, I would like to say that the fact is that since China, Brazil, India, and Russia really had their growth in GDP spurt back in 2004, real WTI prices have averaged more than $80. And so I really think that now, to me, that indicates that the mid-cycle price of oil is around $80. Now, the reason Prince Abdulaziz has been doing what he's been doing recently is to balance the markets, because there was a time of overspend followed by a long period now of underspend in the industry and then the pandemic. So now to balance the markets is best for all of us, because if prices, if he wasn't doing that, then prices could potentially go way up to over $100. But in balancing the market, you protect the downside so that you have a healthy oil and gas industry, but also without damaging economies around the world.
So some of the underproduction or undersupply was because you guys, shale players, so are you doing anything differently if we're at a mid-cycle price of 80 and we have spurts to a 90?
I think that certainly our industry has gotten to the point where we are practicing much more discipline than we used to practice. You see that that prices have been moderated recently, that a lot of people have predicted $120 to $130 oil. You haven't seen it because the industry doesn't want to go there. Since in that time period that I just described, since 2004, prices were above $100 26% of the time. I don't think we'll see that again. I think
Vicki's still capital disciplined, or Vicki's going to pump more?
We're capital disciplined, and what that means for us is that we don't increase oil significantly in a market where we don't see the balance. It would only be in a market where we see the balance that we would increase our production, and then it would be at a moderate pace. We really are much more focused on returns than production volumes.
Any recessionary things that you're noticing or fears? Any demand destruction? Like, are you noticing anything on the backside in terms of demand for you guys?
We don't see any demand destruction at this point. I don't think that if prices went above 100, that it would stay long enough to destroy demand. I really think that we're continuing to see a gradual improvement. And I think even in a recession, I don't think that demand would drop so significantly that it would drop prices.
So we're here at an energy security summit. And part of the line is going to be like, let's unleash American oil, right? If you unleash American oil, oil can go to $40 a barrel, $55 a barrel. You're not going to want that. You're going to need higher prices. So if you got the go-ahead to be like, you can do whatever you want, Vicki, would you? Can you? Are there other constraints?
The constraints really are making sure that you increase value, that you don't destroy value. If you look in those, that 20%, 26% of the time that prices were above $100, a lot of value was destroyed because we drove up the cost of what we were doing. We were inefficient at that activity level, the industry in general. And so now I think there's a lot more discipline around how to do it better, and not to get into an oversupply market.
So if I look forward for Oxy in the next 10, 20 years, you guys are going to basically be a carbon management company. And a big part of that is direct air capture. You suck some carbon out of the air and you either store it or you use it to get more oil. You recently announced that Amazon's going to purchase about 250,000 metric tons of carbon removal credits over 10 years. Huge. It's a big part to get that plant built. What are the financial terms of the deal?
I can't say, but I can say this, that since we started working on selling carbon reduction credits a couple of years ago, the voluntary compliance market has continued to grow. More and more companies are wanting to offset their carbon footprint. There's more than 2,800 companies around the world that have goals to reduce their carbon footprint or neutralize it. Therefore, prices are starting to go up for carbon reduction credits. We can't share prices on contracts, but we can say that we believe that this is certainly encouraging us to know that we can do this and do this in a commercial way. And the important thing to remember is that what we're building here is a technology that the world desperately needs to reduce CO2 out of the atmosphere. And in doing that, what we can do too is provide value to our shareholders. Because if we can't do that, it's not sustainable.
So let me ask it a different way. How hard was it to come to a price with Amazon, or how easy?
I would say that this is a growing industry. An industry is developing out of nowhere to.
This is hard. This is CEO speak for hard. Is that?
This is hard.
Okay, so it's hard.
It's hard. I don't think that we've negotiated a contract yet that didn't take almost a year or more, because people are just starting to understand the industry. Our legal people have never written contracts like we're writing today. So we're at the forefront of this, and I feel like we're leading the way in a lot of ways, especially with respect to these large volumes and and matching that with what companies need to fulfill their goals.
I'm going to ask you one more in a different way, one more time. You get a tax credit for direct air capture of $180 a ton to decarbonize, depending on where you put it, in the ground or back to oil. You have said that companies will be willing to pay above that. Did you learn that that is true with Amazon?
I never can talk about prices on any given contract.
But did you feel good? Did you feel a sense of relief?
But I can say that to make this commercial, there's more than one thing happening.
Okay.
We're also going to, over time, be able to significantly lower the cost associated with these carbon credits. So it's not just the sale, it's not just what you get for it, it's the cost of doing it. So balancing the two of those and getting to the optimum point is where we're headed, and I feel confident we'll get there.
Fair enough. What do you say? So we're at the Energy Security Summit. I know that carbon management is going to be huge over the next, 10 hours here. What do you say to those who say, yeah, but that's just an ability to let you pump more oil? I mean, you've said that you're going to use that carbon to get more oil out of the ground, so that's not going to do anything for us. What do you say to that?
I say that what they don't understand is all the benefits of doing this, because it takes more CO2 injected into the reservoir than what the incremental oil produced from that CO2 will emit when used. So what it does is it creates a carbon zero or carbon negative barrel of oil. And maritime and aviation needs carbon neutral oil to make their jet fuel and their maritime fuel. It's very much needed for that. The second thing it does is it's further lowered, the intensity is further lowered by the fact that you're using infrastructure that's already there. So getting more out of existing reservoirs is a lower intensity, carbon intensity barrel of oil. So that helps. And then the third thing is that it's very important for the world to produce reservoirs like this, because if the industry adopted this all around the world, this is the best thing that could happen from a climate change perspective, because the last barrel of oil produced in the world should come from this kind of reservoir. And especially here in the United States, where we have vast resources and great resources to develop, those resources are not infinite.
And lots of rocks.
And so it's really important to get the most barrels of oil out of the reservoirs we have in the United States. And we can do that today. We have the infrastructure in the Permian to begin there. And then as we begin there, expand that, we can do it in the rest of the areas here in the United States. That guarantees more energy independence for the United States.
I like the pitch. It's a pitch. You did her pitch. It was a good pitch. Before I let you go, just to tie into what's happening in the broader world, yields are higher all across the board. Is that impacting how you're doing with Oxy at all, or how are you looking at that? Does that tell you anything?
Well, I think that it's important to that happens for a healthy industry.
Okay, fair enough. All right. Thank you so much, Vicki. I appreciate it. Vicki Hollab, she's President and CEO of Oxy. Guys, back to you.
All right, and Alix, thank you very much for that interview. Alix will be back in the next hour for another interview with Doug Lawler, the CEO of Continental. Coming up next, though, summer is ending, so where do we stand in the summer of strikes? We'll have the latest on the United Auto Workers ahead of President Biden's plans to join the picket line in Michigan tomorrow. This is Bloomberg. This is Bloomberg Markets. You're looking live at the Principal Room. Coming up, a one-on-one with Republican presidential candidate Nikki Haley. That's at 1:30 p.m. New York time. This is Bloomberg. After nearly 5 months on strike, Hollywood screenwriters have reached a tentative new labor agreement. President Biden just moments ago releasing a statement praising the deal and saying, quote, "I urge all employers to remember that all workers, including writers, actors, and auto workers, deserve a fair share of the value their labor helped create." The president, of course, is set to travel to Michigan on Tuesday to support striking members of the United Auto Workers. Meantime, former President Donald Trump plans to do the same on Wednesday. For more on the current state of the negotiations between those auto workers in the UAW and the big three automakers, Bloomberg's Craig Trudell is with us. Our global car czar, who is usually in London but is in New York today and I believe heading to Detroit tomorrow as all of this is going down. Craig, great to see you. Of course, on Friday, we saw an escalation of the strike, it expanding to all of the parts distributors for both GM and Stellantis. Was any real progress made in talks over the weekend? What's the latest?
We didn't hear any meaningful updates really over the weekend, and I think the escalation that we saw on Friday was a little bit muted on the part of the union. So these parts distribution centers absolutely are going to have the potential to affect the dealer level, how consumers have potentially have trouble with getting their cars repaired over the next weeks or months, depending on how long this lasts. But we have not seen an addition of more assembly plants or maybe specific parts plants or engine or transmission plants that would really sort of result in substantial disruption to the industry, at least from a manufacturing perspective. We also encouragingly for Ford heard that the union felt encouraged about the amount of progress that they're making with that company in particular. So this is at this point 2 companies rather than 3 that the union is really putting pressure on and sort of taking to task for, in its view, not going far enough to sort of meet their demands.
Craig, what impact will the president's trip to Detroit have, do you think, on how this story develops from here?
I think it's going to be really interesting to see, Biden tomorrow, Trump the following day. I think we did see some hesitation on the part of the union to embrace, White House involvement here. Sort of, a reluctance for some of Biden's deputies to get involved. They wanted this to be a matter, between these companies and the union. And I do think that maybe sort of became too much pressure to resist on the part of the White House, wanting to send a clear message that they're on the side of the union, and Trump kind of trying to assert himself. And I think the UAW leadership very much has been on the side of Biden, and yet the president of the union was very clear to our colleagues in the Detroit bureau of Bloomberg very recently. Talking about some of the messages that Trump sends to workers resonating, this idea that there is real concern on the part of the workers of this transition to EVs and what it's going to mean for their jobs going forward. And that's at the center of these negotiations. There's a real concern about whether or not some factories may go down as a result of the fact that we're going to shift from engines and transmissions to batteries. And we do still have a lot of factories in the U.S. that specifically make engines and transmissions that won't necessarily, easily be able to one-for-one make that switch to batteries.
Yeah, and we understand based on what Trump's advisors have said that he's going to talk about the idea that all these jobs are going to go to China instead, given the EV transition. Just on that note, though, Craig, of job security, we understand that that is really a sticking point in the conversations with Stellantis, at least, but I'm sure that goes more widely for all of the big 3 negotiations. That one feels like it's harder to resolve than just deciding what the number is on wage increases.
Yeah, I think that rhetoric about these jobs are going to go to China is absolutely misplaced, and it's a result of the fact that the amount of subsidies going into trying to lure battery investment in the U.S. Is substantial as a result of the Inflation Reduction Act, and is resulting in real investments by these 3 companies and companies like Toyota. Volkswagen, a lot of companies, the amount of investment flowing into North America is really substantial, and you're seeing, concern globally about that, about, Japan and Europe and Korea, being very concerned about the fact that the U.S. is really trying to assert itself in luring some investment. That being said, that doesn't mean that there won't be some disruptions here. And so we're going to have, some real trade-offs and challenges at the worker level as a result of this transition.
It's interesting that China issue is being used here in Europe as well. A debate taking place between the UK and the EU. The German automakers certainly saying, you've got to fix this because otherwise, basically, you're making us less competitive against Chinese imports. Craig, thank you very much indeed. Craig Trudell joining us from New York, soon to be in Detroit. Some great coverage coming up of what is happening with these strikes over the next couple of days. Coming up on this programme, the SEC is said to have collected messages from staff of more than a dozen investment firms. More on the investigation into the use of private messaging apps. Today's Wall Street Beat is coming up next. This is Bloomberg.
It's time now for Wall Street Beat, where we look at what's buzzing on Wall Street in the world of banking and finance. And today, we're looking at the SEC's investigation into Wall Street's use of private messaging apps. Joining us now is Bloomberg's Sonali Basak. So, Sonali, by now we're all very familiar with this story. There's already been, I believe, $2.5 billion worth of fines given out related to this. But now the SEC is actually combing through a lot of these messages. Should we be surprised?
They're combing through messages now of the next phase of what this investigation spans to. That is investment advisors. Remember, we only really know that they're collecting those messages, those WhatsApp messages and other unauthorized apps. We have names to the firms: Blackstone, Apollo, Citadel. This is all according to Reuters. Carlyle, TPG. These are the massive private equity firms and hedge funds that the SEC and the CFTC are really now expanding the scope of the investigations to. Now, remember, when you look at what they've been looking at already, to your point, it's been $2.5 billion worth of fines. You've had domestic banks that have settled. You have also had international banks that have settled, the likes of BNP and Deutsche Bank and others. Now, remember also that as we watch them kind of expand the scope of what they're looking at, this kind of unauthorized use of messaging systems, you have to kind of wonder how far and wide will this really go at the end? Will they also start to look into RIAs, for example, firms that are smaller than some of the giants that I had just named over to you that have been expecting these moves for months?
Sean, just to be clear, so the first set of fines were basically, you've been using it, you shouldn't have been using it, therefore we're going to find you. Now they're starting to read them. In trying to read them, what are they looking for?
Well, you have to remember that the reason this happened in the first place, and I think a lot of people tried to pin it on the pandemic, but if you look at what had happened, you have the SEC really looking at messages that went back far beyond the pandemic. Messages at JP Morgan going back to 2018, for example. And so what are they looking for? They're saying that it's making the SEC's job harder, regulators' job harder to parse through messages as they need to in the event of any regulatory matters. But now what they're saying here is that you shouldn't be using these unauthorized forms of communication in the first place. So a little bit of a chicken and an egg issue here as kind of the use of technology has expanded so far and wide on Wall Street. Asset managers are taking this very seriously. You know, I had mentioned this idea to folks over at a lot of those firms that we have named, and some of them are very afraid to talk to people on things like WhatsApp and communicate on places like Signal for this reason. So it certainly has had an impact. And there has been a response from the industry, lobbying groups saying that the SEC is overreaching in these regards. We are only talking about the collection of private messages here, Guy, as the SEC tends to do. But remember, this is now a situation that is expanding well beyond the biggest banks and into many more members of the financial community.
It's amazing to see how this is just growing and growing and growing and growing. Where does it end? Sonali, thank you very much indeed. Sonali Basak on what's happening with the WhatsApp, Signal, etc. story that we're watching so carefully and have watched, as Kaylee says, for quite some time. Where does it go next? Stock 600 down by 1% today. European stocks have been really down from the get-go this morning. The narrative out of China wasn't clever. The narrative out of Asia wasn't good. The bond, it's just a sea of red out there, basically. The UK 30-year, look at what we're looking at there. Long duration bonds, that's an 11 basis point move. These are really, really chunky moves. It was interesting listening to Ira Jersey in the beginning of this hour talking about the fact that the genesis of maybe some of this move that we're watching here, certainly since last Thursday, comes out of Europe. not front end, it's the long end that is moving so much. Euro dollar down by 0.7%, 105.78 is where we're trading there. Christine Lagarde's been talking today. We've got big CPI numbers coming up later on this week. What does this all mean for European equities? Emmanuel Cao, Barclays head of European equity strategy, is joining us next. This is Bloomberg.